Factoring and Forfeiting. So in this session, what we do is we try to explain what is a factor, and we'll also see the processes behind a factor. What are the different processes one actually uh, does for the function of factor to go smoothly. We also would see what is forfeiting and the process behind forfeiting. So first we'll take a look at what is a factor. A factor is an agency that makes factoring, which is an arrangement with a business concern, which is again a financial service provider wherein the factor undertakes the task of realizing book debts and bills receivable of the business concern for a commission. So factor undertakes the task of realizing book debts and bills receivables of the business concern for a commission. So here broadly we have three players in factor while we do factoring. One is the factor, one is the firm, and the other one is the debtors. So normally a firm sells their book debts or bills receivable to a factor. So first of all, we will have to see what is a firm and who are the debtors. So a firm actually provides goods and services to its customers. Now customers may buy these goods and services for cash, or they may actually buy these goods and services on credit. When the customers buys or gets goods and services on credit from the firm gets what is called as book debts or bills receivables, which are records based upon which the firm would get the money spent by the customers. So the customers here becomes debtors, and the firm has now book debts or bills receivable. There is a lot of management effort which needs to be done if the firm has to collect these book debts or receivables from the debtors or the customers who has purchased goods and services on credit. So in order to lessen this, what is there is that there is this concept of factor who comes in, who just buys the book debts or bills receivables from the firm, and then they do make the collection attempt of the money spent by the firm otherwise from the debtors. They try to collect the money, and then they receive a commission, and then they give this money to the firm. They receive a commission on behalf of the firm. So factor has business concerns as their clients and undertakes to realize the debts owed to the business concern and bills receivables by making their clients' debtors make payment to the client or the client's creditors. So as I was explaining, there are three players here who are the factor, firm, and debtors. Firm sells their book debts or bills receivables to a factor. Factor, who is the agency that undertakes a firm's book debts or receivables, they also collects the money which the debtors owe to the firm and give back that money to the firm and receives in return a commission from the firm. So that is the arrangement of factor. Now, according to a report submitted to RBI, Mr. C.S. Kalyanasundaram has explained factor as a continuous arrangement under a financial institution that assumes the collection functions and credit for its clients by purchasing the receivables as they arise with or without recourse for credit losses, and attends to other bookkeeping duties and maintains the sales ledger to such accounts and performs functions. So that is what is in general, in a nutshell, what is factor and the factoring. Now we will try to explain the process followed by the factor in the arrangement of factoring. Before we get into that, few things we have to understand. So factoring, as I was telling earlier, involves three players: a firm who sells goods or services, a factor, which is a financial institution buying into a firm's book debts or account receivables, and a debtor, who are also firm's customers who have purchased firm's goods or services on credit. Now, the following is the process of factoring. So what are the process? The firm gets an order of purchase of services or goods on credit through its customers. Firm sends invoice to their customers or debtors and also sends goods or performance service and perform service, and then the firm informs the customer or directs its debtors that the invoice assigned to the customer should be paid to a factor. Firm also sends the customer invoice to the factor, which is a valid proof of credit of sales and dispatch, credit sales and dispatch. Factor, by buying the book debts or accounts receivable, prepays the firm to the extent 90% of the invoice value. So the moment they buy the book debts or bills receivables from the firm, they pay outright 90% of the invoice value to the firm. Then the factor follows up with the customer who has bought goods or services on credit from the firm for realization of the payment due. They follow up with the customer. Debtor pays the money to the factor on due date, or in other words, the factor collects book debts. Factor, after collecting money from the customer, does pay the balance of the invoice value to the firm, but the firm also gives a commission to the factor. So that's a process by which the arrangement of factoring works. Next, what we'll see, what is forfeiting. So forfeiting basically in French means to surrender one's right on something to someone, and is a popular form of financing of account receivables arising out of international trade. This is done by discounting export receivables by taking proper evidence on matters like bill of exchange or promissory notes without recourse to the exporter, carrying long-term maturities to medium on a fixed rate, which is 100% of contract value. So forfeiting, we have to know that it is extended to export of capital goods, services or commodities, where exporter may insist on supplies on credit terms. Because exporter, as you know, basically exports goods or services or goods to the goods to another country, and the importer basically are there who gets it in a foreign country, the goods which is exported by a particular country. So in forfeiting, what you have to understand is that this is done by discounting export receivables by taking proper evidence on matters like bill of exchange or promissory notes without recourse to the exporter, carrying long-term maturities to medium on a fixed rate, which is 100% of contract value. Also in forfeiting, there are 4 parties in a transaction, which are exporter, importer, importer's bank or guarantor, discounting bank or forfeiter. So there are 4 players in forfeiting. Now we briefly explain the process of forfeiting. So the process of forfeiting is where there exists a proposed export sales contract between an exporter and an importer. The importer approaches his local bank to issue letter of credit, which is a guarantee in support of promissory notes or bill of exchange in favor of the exporter. The exporter approaches the forfeiter, who is the discounting bank, to establish terms of forfeiting. The forfeiter or the discounting bank quotes the discount rate after estimating risk. The exporter sells goods. Importer draws promissory note in favor of exporter. Exporter draws bill and gets acceptance of the importer. The exporter enters into forfeiting agreement with the forfeiter or the discounting bank. Exporter sells bills or notes to the forfeiter at discount. Forfeiter, who is the discounting bank, presents the bill to the importer for payment on due date or may sell the bill in the capital market. So that is basically briefly the process of forfeiting. Now, what are the salient features of forfeiting? The salient features of forfeiting are: forfeiting is used to finance only export business. It involves export bill and purchase of export bill. It is mainly towards single transaction backed by a bank guarantor or a letter of credit. It is both a long-term or medium-term financing with credit period that extends from 180 days to 7 years. The exporter must manage the export receivable account because a forfeitors, who's the discounting banks, responsibility extends to the collection of forfeited debt only. So the export receivables account should be managed by the exporter. Forfeiter or the discounting bank's responsibility extends only to the collection of forfeited debt only. The transaction should be of minimum value of US dollars 2,50,000 or 250,000. The forfeiter may realize the export bill in the securities market or hold on to it until due date. So these are the salient features of forfeiting. So with that, we come to an end of a brief session on forfeiting as well as on factoring. Thank you.